Good morning. DSCR explained for commercial investment property and why good deals still get denied, but how to fix that. And if you're investing in commercial real estate, you've heard the term DSCR thrown around constantly. But here's the truth that most investors miss. You're not underwriting the deal. The lender who's advancing you funds is. And DSCR, or debt service coverage ratio, is the filter that everything really runs through for that credit decision. So, what is DSCR? Well, debt service coverage ratio is the full explanation. And at its core, DSCR measures a property's ability to cover its debt. So, the formula there is your DSCR equals your net operating income, or NOI, divided by your debt service. And your NOI is the income after operating expenses, but before your debt. And debt service is equal to your annual principal and interest payments combined. So for 200,000 NOI with a debt service of 160,000, the debt coverage ratio is 1.25. And that means the property generates 25% more income than is required to pay the loan back. And what do DSCR lenders require? Well, most lenders fall into these ranges, 1.2 to 1.25 plus. Is minimum for most deals, and 1.25 to 3.5 is strong and preferred, and some are north of 1.4 and 1.45. Better terms get better leverage. And the DSCR is based on their numbers, not what you're coming up and presenting, because they're going to stress test and verify for accuracy. So how NOI is the foundation of debt coverage ratio and where most deals can fall apart. So lenders can make adjustments that kill deals. So adding management fees, even if it's self-managed, pretty common. Normalizing property taxes after the sale and increasing insurance estimates based on current market, but also removing one-time income and scrubbing unrealistic rent projections. So you think this, $200,000 in NOI, and your debt coverage is $1.25. The lender sees adjusted NOI of 175,000, which brings the DSCR to 1.09, and that deal doesn't work, just at that loan amount. But same property, different underwriting is the point. So the role of reserves, and this could be your silent deal killer, and even if your DSCR works, you can still get declined. Why? Well, because lenders care about liquidity and survivability, and not just cash flow. So typical reserve requirements would want to see, say, 6 to 12 months of payments. So taxes and insurance included, your full expense. And sometimes additional CapEx reserves too. But why that matters? And the point is, if the deal has a thin debt coverage ratio with tenant rollover risk or any value add component, lenders will tighten their reserve requirements or reduce leverage, which basically you need more cash into the deal or in your pocket. And why cash flow strong deals will still get denied. And this is where most investors can get frustrated. And they're looking at it from the cash flow perspective, but it cash flows. Well, here's why that doesn't matter to the lender. And lenders are not going to trust pro forma statements. They underwrite to the in-place income and not projected income, unless you can find a bridge fund. And then it's possible, then you're paying a much higher premium for the cost of financing. Two, they look at the debt coverage ratio and they stress test it. And they may increase the interest rate used in underwriting or apply vacancy assumptions or use more conservative, more expenses. Three is debt yield and risk layering. So even if debt service coverage ratio works, a low debt yield or weak sponsorship or limited reserves can also still kill the deal. Four is property type risk. So certain asset classes are say, for instance, older retail, older office buildings, special use buildings, often get lower leverage with a higher debt coverage requirement and more strict underwriting. So let's talk about how to think like a lender and win more deals. And if you want approval consistency, shift your mindset and underwrite like this. Use the most realistic expense ratios, but also normalize taxes and insurance because insurance cost is rising everywhere. But assume higher interest rates And that way you can build in vacancy and reserves and win all the time. Structure beats rate every time, and most investors chase the lowest rate. But smart investors are also focusing on the better structure of the transaction with a stronger debt coverage ratio, positioning their liquidity better. And this is where brokerage and financing come together. And this is where other brokers may fall short and where you can win because you work with a team that does. And a great deal isn't just the location or the price or the upside. It's a deal that gets financed cleanly. So the winning strategy is to identify deals that meet lender DSCR early, structure offers based on financing realities, and align purchase price with the NOI and not emotion. So the final takeaway is that you're not buying a property, you're buying a debt structure that has to work. And if your debt service coverage ratio doesn't meet the lender thresholds or survive stress testing or align with the reserves, the deal doesn't exist. It's just a fugazi. So if you want help underwriting your next deal like a lender with a brokerage mindset, let's structure it right the first time. My name is Bill Rapp. You can visit my website, HoustonRealEstateBrokerage.com, to figure out how to get a hold of me. Love to talk to you more. Take care.